Hi everyone, welcome back to another episode of Trading Kaki's weekly series. So last week, while we did not have any stock picks for you due to the volatility in the market, we did give you very key information with regards to the SVB collapse, and it did in fact play out pretty nicely according to what we had predicted, which is the collapse of other banks, including big banks such as Credit Suisse. So if you do want to keep updated on these key news as well as the events that we do predict would happen, do remember to like, subscribe, and leave a comment if you would like to see other similar content or any questions that you may have. This week we had all the key inflation related data that came out. First we have Consumer Price Index or CPI, which came in at 6%. This was the lowest since September 2021 and was in line with market forecasts. Food prices, which are one of the more volatile items, grew at a slower rate, whereas for energy, which is the other more volatile item, slowed sharply. If you strip out food and energy prices, which are the two more volatile items, core inflation also came in lower, and this was also in line with market estimates. We don't really see a very big take-up for the consumer prices as we mentioned earlier, so inflation is in fact seeing some positive prints. And for the producer side of things, that is also happening, with it going down 0.1%, and this was below market expectations of a 0.3% increase. On the other hand, retail sales were not as positive. It was down lower than what market had expected, and inflation is not adjusted for within retail sales. So that means that consumers are not actually spending as much as what the market had predicted. And why are they not spending? This is probably because consumer sentiment had dropped, and it in fact had dropped for the first time in 4 months. So consumers are probably taking on a more cautionary approach, especially as they price in recessionary fears going forward. So they are probably saving more and spending less, which is why retail sales, despite the drop in inflation, is coming in at a lower reading than what market had forecasted. These are the key macro events happening next week. Probably the most key one would be the Fed interest rate decision and the FOMC press conference. That would allow us to see which direction the Fed would pursue, especially with the onset of the banking crisis. The market saw quite a bit of volatility this week, on top of it already being OPEX week, which is the third week of every month where options contracts expires. It is also one of the quadruple witching dates, which happened on Friday this week. This is a date that happens 4 times a year. This is when not just options contracts, but also futures contracts and options on futures contracts expiring. So with all that happening all at once, we can see quite a bit of volatility coming in towards the end of the week, which we saw this week. So the SPX broke out of the downward channel but rebounded. It is currently trading within the downward channel, and the support level will be the 3800 level. The Dow Jones Index broke out of its 31.7 support level but rebounded quickly. It consolidated above it this week, and the following two support levels continues to be 31.7 and 31. The Nasdaq outperformed the other indexes this week, and it closed at the upper bound of its downward channel. The following resistance level would be the 16.5, and the support levels are 11.5 and 11.4. Small and mid-cap stocks completely wiped out the year-to-date gains, with the Russell 2000 closing near the support level of 17.25. It could possibly retest last September-October's lows of 16.5 if the downward momentum continues. Volatility continued to spike, as you can see from the crazy candlesticks this week. It stayed above the 200-day EMA. In fact, it did once touch 30 but pulled back. Investors are still concerned about the banking crisis and hedge against further market downturns. The dollar index broke down out of its upward channel and stayed below its 200-day EMA. China's tech sector, which comprises the bulk of the Golden Dragon China Index, saw some boost this week due to the launch of GPT-4, which is a new and improved version of ChatGPT. Even though China AI stocks are not directly related to ChatGPT or its likes, it does improve investor sentiment on the potential of AI stocks in general, and stocks such as Baidu is seen as an alternative investment compared to the US AI-related stocks. As the banking crisis unfolds, we see more and more investor demand going towards the US Treasuries, and this is evident in the 10-year yields and the 30-year yields, both of which have narrowed sharply this week. With yields dropping and investors coming on a risk-on mode, we see cryptocurrencies benefiting from this, and in fact, for this week, it was one of the best performing asset classes, with Bitcoin recovering to last June's level and Ethereum climbing back to last August's level. It's no surprise that the financials are one of the worst performing sectors with the current banking crisis, along with materials and energy, and the best performing sectors are technology, communications, and utilities. As promised, we kept a watchful eye on the banking sector and the events that unfolded. So the SVB fallout is just one incident in itself, and it will have contagion risk to the other banks, especially regional banks and even big banks such as Credit Suisse. The big banks were not spared either. We see Credit Suisse, which is one of the global systematically important banks, selling off as well. This is because its largest shareholder, the Saudi National Bank, said that it will not buy any more shares. It's currently being built up by the Swiss National Bank, which is providing a liquidity backstop to Credit Suisse. On top of that, we have UBS Group exploring an acquisition on all or parts of Credit Suisse Group. Separately, on Thursday, we see the biggest US banks, including JP Morgan, Bank of America, Wells Fargo, and Citigroup, banding together to rescue San Francisco lender First Republic Bank with $30 billion of uninsured deposits. As you can probably tell, it's really a doom and gloom situation right now for the banking sectors in Europe and the US, and investor sentiment and confidence in the banking sector has dropped the most since the 2008 global financial crisis. However, there's always a last resort, which is the central bank. We mentioned earlier when we were covering the treasury yields that more and more investor demand is going towards the US treasuries. And in just 1 week, the Fed balance sheet had reversed the downtrend and expanded by nearly $300 billion. So you can probably see that the quantitative tightening cycle is over and a new round of quantitative easing would begin. So as mentioned earlier, investor sentiment had totally changed overnight, or rather over the week. And previously, it was expecting the rate hike cycle to end and reach peak interest rates towards the end of the year. However, right now, a new rate cut cycle would probably begin towards the end of the year. This is a huge turn from what had previously been expected. Inflation continues to be very far away from the 2% inflation targets that most of the major economies around the world are targeting towards. So a high inflation is probably a new normal that most of the world would have to adjust to. Wealth from those who have little or no real assets will continue to be consumed by inflation. We will cover the key earnings of two companies, Adobe Inc. and FedEx Corp. Moving to a subscription model helped Adobe Inc. greatly, as we see its revenue and earnings beating estimates. On top of that, during the quarter, Microsoft mentioned that it was embedding Adobe's Acrobat PDF engine into its Edge, which is the browser in Windows 10 and 11. It has also been engaging with regulators on its acquisition of Figma, which is a design software startup. FedEx revenue missed estimates, however its earnings beat estimates by a long shot, and this was primarily due to the efficacy of its cost-cutting measures, which it continues to price in for its full-year earnings forecast. The cost savings plans includes reducing headcount and improving courier efficiency, alongside already increasing shipping rates as they have done so in January. On top of that, the management expects courier volume to be increasing in the next 2 quarters. Now with the banking crisis unfolding and we already see some key events playing out, we do have 2 stock picks for you. First would be Microsoft and next one would be Barrick Gold. If you have already used ChatGPT in one way or another, you already know that it's pretty amazing. And GPT-4 comes in as a game changer, as it's not only able to generate content based on text prompts but also image prompts. And according to the latest technical report, it's even able to score and ace several AP exams as well as a simulated bar exam. The updated development mentioned that it would be integrating GPT-4 into its Office suites, and with that, Microsoft would be able to increase revenue by raising prices for these extra embedded packages. The expectations for a cut or pause in the rate hike cycle will be a tailwind for the tech sector, especially for stocks like Microsoft, as they are considered growth stocks, and rate cut expectations will be good for the tech sector as a whole. Our recommended entry for Microsoft will be at $270 with a target price of $300 and a stop loss price set at $255. This next one, Barrick Gold, is our key pick within the gold sector. As we mentioned earlier, the current banking crisis made many investors rush towards safe haven assets, including US Treasuries and gold. On top of that, the anticipated slowdown or even pause of the rate hike pace would lead to a lower dollar index, which will be good for the rally of gold prices, as the gold prices are usually denominated in US dollars. Our recommended entry price for Barrick Gold will be at $17.5 with a target price of $20 and a stop loss price at $16. That's all we have for this week. Please like, subscribe, and also do leave a comment, especially if you have entered any of our stock picks previously. We would love to hear from you on any other content as well that you would like for us to cover.